Welcome to PM in the PM. This is the weekly Monday afternoon podcast where I take a news item and look at how it links to the ACCA performance management syllabus areas. The benefit of listening is that by seeing this real-world application of what you're learning on your day-to-day studies, you're more likely to remember, but also you'll give better quality answers, particularly where you're answering application questions. And of course, this won't only help with performance management, it will help with other parts of the course, including advanced performance management. And given that we've just had the autumn budget in the UK, it has to be that this first PM in the PM podcast is around that budget. Now, I'm not looking to break down what happened in the budget, but I did notice a couple of areas which were quite pertinent to the performance management syllabus. And these areas, they will come up within potentially Syllabus Area B under traditional pricing and throughput accounting, under Syllabus Area C, relevant costing, and Syllabus Area D, budgeting. So the changes that came about in the budget this week in the UK, first there was one around business rates relief. Now, business rates is a tax paid by commercial organisations on the bricks and mortar property which they operate from. And a number of businesses have benefited from a partial relief of 75% on the normal rate. And this has been reduced to 40%. Another big change was around national insurance. So in the UK, when people are salaried, they pay tax and they pay national insurance, which is another form of tax, but also the employer pays national insurance. And that previously has been at 13.8%. And that was increased up to 15%. But also the threshold changed. The threshold where that national insurance employer's contribution started was £9,100. It's now dropped to £5,000. And the third change was an increase of about 6.7% on the minimum wage. So how do I think this relates to performance management? Well, it's around fixed costs and variable costs. Are these fixed costs for the business or are they variable costs? Well, I hope it's pretty obvious that the business rate relief reduction would be a fixed cost. But how would we treat that minimum wage change? So instead of an employer paying what they're paying now, is going to go up by 6.7%. So now the company is going to have to pay more national insurance contributions to the UK government. So are they fixed costs or are they variable costs? Well, the true answer is it depends. And it actually depends on what part of the syllabus that we're looking at. If we look at traditional pricing and perhaps we're looking at target costing versus traditional costing, and that comes up in Syllabus Area B, we generally would treat all of these as variable costs. And also in budgeting, which will be in Syllabus Area D, we also treat them as variable costs, unless we treat them as fixed costs. What do I mean by that? So if you picture a cost card, it will show direct materials as one line, and it will show direct labour as another line. That labour cost is a variable cost, but then further down, you'll have a fixed overhead allocation. And that fixed overhead allocation will include salaries from perhaps the finance team or the HR team, which are allocated to that cost card, but then it's seen as a fixed cost. But we don't stop there, because also in Syllabus Area B, we've got throughput accounting. Now, if you've studied throughput accounting, I hope it's pretty obvious what the answer is. All costs are fixed costs except materials. It's an assumption we make when doing throughput accounting. All costs are fixed costs except materials. So these changes would absolutely be treated as fixed costs if you're looking at throughput accounting. And this makes sense in a way because most people who are listening to this are probably salaried. And if you're salaried, it doesn't matter how much work your organisation needs you to do, you're probably paid the same amount. I appreciate overtime and 0-hour contracts and performance-related aspects complicate it, but on the whole, in general, most people's salaries are fixed, and therefore the salary costs for the company, including taxes that they pay on those salaries, would be considered fixed. In throughput accounting, all costs are fixed except materials. What about relevant costing? Relevant costing comes up in Syllabus Area C. And relevant costing is used when we're looking at minimum pricing decisions, accept or reject decisions, make or buy decisions, whether to outsource. So how do we treat the changes for relevant costing? And once again, it depends. For a cost to be a relevant cost, it has to occur in the future. So it seems to tick that box. The company will be paying the salary and the national insurance contributions in the future. It needs to be an actual cash flow. Well, it is. Absolutely, money will go from the company, some will go to the employee, and some will go to the government. It needs to be incremental, i.e. specific to the decision. So if the company was to incur that salary cost anyway, then it's not incremental. And this could happen if they had spare capacity. So if you have a company that has salaried people who for some of the time don't have enough work to do, that's spare capacity. So that would not be an incremental cost because they could be allocated to this new project or this new initiative and it wouldn't cost the company anymore. So that's not an incremental cost. But if they had to pay them overtime, then that would be an incremental cost. So when it comes to relevant costing, once again, it depends. And the other aspect we need to think about with relevant costing is whether it's an opportunity cost. So let's say once again we have some salaried people, but they have no spare capacity. And by taking them off whatever they were going to be working on to work on this new project, there's an opportunity cost. We lose the benefit of what they were doing originally, and that is a relevant costing. And I thought this was an interesting area, particularly that impact on national insurance and minimum wage, because it depends which aspect of the performance management syllabus you're working on as to how that would be treated. So thanks for tuning in and listening to PM in the PM. I hope you found this episode informative. I'd love to receive your feedback in the comments, but also please share the link with any colleagues who you think might find these useful. Until next time, this is Richard Guyver, signing off.